This is Joseph Giacobelli. I'm an analyst, investor, author, and the host of the Asia Climate Finance podcast, which is a philanthropic series dedicated to the promotion of knowledge and discussion on sustainable finance in Asia, from the perspective of the business of decarbonization and the energy transition in the region, which consumes about half of the world's energy and electricity. Please support this effort by liking and by subscribing to the podcast. Welcome to episode 21 of the Asia Climate Finance podcast. Today my guest is Jan Napiorkowski. Jan is the global head of clean energy based in Hong Kong for Ariel Re, a multi-line specialty reinsurer. And Jan will tell us a little bit more about what he does and what Ariel does in a minute. The discussion really is twofold. One, really talking about the basics of what insurance is all about. And I do think that insurance is one of those areas in sustainable finance which perhaps is not discussed enough. And then after that, the second part, we'll discuss a little bit more in depth about technologies and a couple of examples as well. Enjoy the show. Hello and welcome to episode 21 of the Asia Climate Finance podcast. I'm very excited today to have an old friend of mine, well, young, but old friend of mine, Jan Napiorkowski. Jan is a vice president at Ariel Re. He's the head of clean energy risk solutions globally for the Ariel Re Syndicate. And hello, Jan, how are you? How's life in Hong Kong?
Hi, Joseph. I'm very pleased to be invited. Appreciate. I know you're enjoying the beautiful weather and food in Portugal while I'm sitting still in rainy Hong Kong. But it's life is getting back to normal here, and I'm very excited to be back here after a couple of months, after actually a longer period of time in Europe.
Great. And I think, Jan, maybe we start with a little bit about yourself, maybe just a quick self-intro.
I'm by background a physicist, but I've never made it to become a scientist. I somehow fell into the trap of the financial industry, which allured me many years ago, and went after studies straight into working as an actuary in insurance companies. And then I had various roles across the insurance and reinsurance industry. And in 2008, I was asked to develop a novel insurance product to cover liabilities resulting out of manufacturers of renewable energy equipment, in particular solar modules, selling their modules with warranties. And we were asked to develop a product which would insure those warranties and backstop those warranties. So since 2008, I had been underwriting and placing insurance products for the clean energy sector and everything related to the performance of clean energy technologies for two different reinsurance companies, and currently, as you mentioned, for a syndicate at Lloyd's, Ariel Re.
Got it. So you got involved into clean energy and, I guess early on in the energy transition back in 2008. And what about in Asia? When did you start getting involved in Asia?
Pretty quickly thereafter. First, I was in Europe in 2008 and 2009, and after we have insured a few European manufacturers of solar panels, as you know, the manufacturing was moving very quickly further east. So we had a lot of inquiries from back then still Taiwan and Japan, a bit of Korea, and then China was starting up, and I moved to Hong Kong late 2010.
Wow. So you're really there from the kind of beginning of a slow but major boom in the industry in this part of the world. can we? I mean, my background. I'm more of a financial analyst, equity analyst, and I'm not really 100% on top of insurance and reinsurance markets in general. So, could you start maybe with the basics for those of us who are not 100% familiar with this world? First of all, why do renewable energy projects need insurance in the first place? I mean, I get the fact that maybe there's a fire or there's some kind of natural calamity, but are there other reasons why the RE projects get insurance and or reinsurance?
Yes. So maybe first let's make the distinction between insurance and reinsurance. I think it's sometimes misunderstood in the industry because some reinsurers are it's usually the reinsurance companies coming with new, more complex industrial insurance products to the industry. And why is it the reinsurers and not the insurers? Typically, the role of insurance companies is to distribute products, and then they decide how much of the risk they want to maintain, but they usually reinsure vast majority of the risks that they write to reinsurance companies. It's really the reinsurance companies which are holding the risks. And I'm not talking here about, super large, the likes of Allianz or QB or CHAP, which obviously hold much more of the risks than the other typical primary insurance companies. But a reinsurer is really there to take the risk, while the insurer is there to distribute the products. Insurers are obviously much stronger in developing retail, more commercial products, and reinsurers are usually more focused on providing more large industrial solutions. When we talk about different insurance products for renewable energy projects, we should distinguish between what we call those traditional insurance products, so those insurance products widely available in the markets and offered by most of the insurance companies. And these are, the typical physical damage insurance products you're referring to, covering against property damage, fire, natural catastrophes like earthquake, hurricane, hail, etc. And those you have for the construction phase of the project, and then for the operation phase of the project. It's a standard requirement for all projects to have a certain set of traditional insurance products in place. And you typically, as a project owner or as an EPC, depending who has the responsibility, or the SPV itself, you go out, find a broker, and the broker will place those traditional insurance policies for you. Now, the space that I'm active in, we don't provide those traditional insurance products. We specialize in providing what we call non-traditional insurance products, so more bespoke solutions. And those are completely complementary to the traditional products, but typically have a very different buying motivation. So our performance insurance solutions are long-term, non-cancelable policies that are covering shortfall in energy production and across various renewable energy, clean energy technologies as a consequence of events which are more driven by the technology itself. So it could be design issues, it could be manufacturing defects, could be material issues, material aging, but it could be also issues related to the volatility or lack of resources like irradiance, or lack of wind for wind projects. So it's a different nature of cover, because the traditional products are so-called force majeure. So we as humans don't have control over what will happen to the project. Maybe with fire it's slightly different, but especially if you talk about natural catastrophes. And for example, now it's very difficult to get an insurance policy for a peril called hail in the US, especially. It's very difficult to get the full project value insured against earthquake in Japan. This is driven by a mix of demand and supply in the industry by insurers and reinsurers. Whereas the perils that we are insuring are really related to the technology itself, but also to the maintenance of the project and to how the companies which provide the technology, build the projects, will understand what they are doing, right? So we need to have our own mechanical, chemical, electrical engineers, scientists in the team who go out and verify the assumptions that the underlying project is making around how much energy they think or how much product they think they can generate over the next 5, 10, 15 years, and how much of that we think we can insure.
Got it. Can you talk a little bit about, still as part of this kind of quick introduction and the basics, about project bankability and the role of insurance in project bankability?
This goes back, I would say, to the buying motivation I mentioned before. So again, if we keep that distinction between traditional and non-traditional insurance products, again, traditional ones more covering force majeure perils. A solar project will be bankable, which means it will be funded, will be debt funded. If you won't be able to place traditional insurance policies for a project, right? An example would be a floating solar project in Taiyuan in the north of Taiwan. Well, we have been approached many times, even if we don't provide those policies, but we've been approached many times, it was a couple of years ago, by small project developers who actually have built small floating solar farms on reservoirs in Taiyuan. And then they realized that actually they cannot get a property policy covering typhoon for those projects, because the likelihood of the project being blown by a typhoon in the next 10 years is probably 100%. Maybe I'm exaggerating, but it's very significant. So either you have to pay a lot of premium for this, or it's just not insurable. So there are still projects which may not be bankable from a traditional insurance point of view, because I would say some basic risk assessment around the project from a physical damage point of view was not made properly. Now, the bankability you're referring to, that I'm more involved in on a daily basis, is related to how bankable a certain technology is, or how bankable a warranty of a technology provider is, right? So, and this goes back to both the maturity of the technology and maturity track record of the technology itself, but also the creditworthiness of the warranty and the balance sheet of the warranty provider. So this is more the space in which my team is supporting the industry. We are always trying to be at the forefront of clean technologies in the market. I think a good example, solar is probably not the best example, because obviously solar is highly commoditized these days, but still, there's new cell technologies coming out now with new types of HIT or TOPCon cells. You have bifacial modules and questions around the ability to generate extra yield from the back rear side of the module. Will be 3 or 13% extra yield, and is there a track record to verify this, and can this be insured? Yes, this can be insured, right? So if we take even a commoditized technology like solar, but there's a concern by the investor around the forecasted yield from a bifacial system, let's say even on trackers, and the risks are related to the extra yield coming from a particular tracker software, which has limited track record, from the extra boost from the rear side of the bifacial panel because of the limited track record for a particular albedo setup. Then these are the technical risks that we have the ability to underwrite, and if we think the predictions are made properly, then we would ensure that elevated yield to the benefit of an investor. But this is more commoditized technology with some novel boost and improvements. But then you can take more novel waste to energy technologies which just don't have a lot of track record. Like you can take an anaerobic digestion plant which is converting, let's say, plastics into fuel, and then the question is, well, maybe it's a 200 million investment, but they only have a pilot plant which is 20 times smaller, which has been running for a couple of months, and investors don't feel comfortable funding the big project based on the limited experience of the smaller pilot plant. And so what we are doing is we are helping to create that link between the available technical information and then taking a view on that risk, and then putting our investment grade credit rating with our insurance policy behind, providing a floor or a kind of a guarantee on the production output for the next 5-10 years of a much larger plant. And this is the bankability, I think, aspect about what you're asking.
If I can put in another kind of simple way, given I'm quite simple-minded about these things, if we think about this in terms of the de-risking or a part of the de-risking of a project, it's a little bit what if I have a project that is a little bit has got, so let's say, newer technologies and a new solar cell, which has got an efficiency of almost 30% allegedly or whatever, then I go to, if I get a loan from ADB or AIB, that would de-risk my project. Actually, that's theoretically the function of these banks, although very often they don't do what they're supposed to be doing, but that's another conversation for another day. So the de-risking, it's really a de-risking tool for kind of newer technologies, at least part of what you do. Am I thinking about this right?
Yes, I mean, when it comes to those large international financial institutions, probably a big part of how they are supporting industry is funding projects where the offtakes, where there is a significant credit or political risk around the offtake, right? This is not the space that we are not insuring credit risk. We're not insuring political risk. We're insuring technology risk, degradation risk, performance risk. So actually, it's a combination of both, right? I mean, so if we go back to the early days of the industry, let's say 2010, 11, 12, and we take the investment grade feed-in tariffs in Japan, obviously nobody was really concerned about the political risk or the credit risk when it comes to how the generated yield will be monetized into revenues. So it was really more just will we generate a certain amount of yield? But if you build the project in a country where you have concerns around the government subsidy schemes, or maybe it's only PPAs with a local utility, which is a government-owned utility, then I think this is where the international banks are coming in with that support on the offtake side. But still, as you say, the technology risk is there, right? So if a new solar cell, which comes with high efficiency, has unproven degradation patterns, there is ways to try to understand how that degradation will behave over 5, 10, 15, 20 years. There is no one and clear way of understanding and identifying this, but this is what we underwrite. We look at the availability of certain stress tests, third-party tests, accelerated aging tests, and we try to understand what we think the volatility around that degradation is. And then if this is a relatively new company with a weak balance sheet, and they will definitely come out with a 25-year warranty because they have to be commercial. That warranty is not backed by any form of balance sheet, right? So it's a natural way that they want to transfer that risk to a investment grade balance sheet.
That whole technical assessment must be call me a nerd, but the whole technical assessment must be really, really fun. But again, that's something I guess we can talk over a nice bottle of wine. If I can move on,
it was fun. it was fun. It was fun in 2008. I can tell you that. In 2009 and 10. Yeah.
I'm sure sometimes you must have been a little bit losing sleep at night. But anyway, in terms of just to get another kind of high level understanding, could you just talk a little bit about three market profiles? One is Europe in general, what's going on there, given that Europe has been at that clean energy game a little bit longer than peers. And then secondly, could we focus on Asia and what you see in terms of developments here? And thirdly, and I'll remind you of these three areas, don't worry. And thirdly, if we can talk a little bit about the merchant markets and the non-merchant markets in Asia and how you kind of look at these from an insurance perspective. So shall we start with Europe? And are we? I'm saying this because I'm Italian, you're Polish, but are we Europeans the leaders when it comes to insuring clean energy projects in terms of experience?
I think we are not. I mean, I think the Americans are, clearly. I mean, at least in our experience, and this can be also driven by the fact that maybe we had been historically not. The team did not, and also our friendly competitors historically, we did not have as much presence in Europe as we had in the US and in Asia. And this was predominantly driven by the fact that Asia was the manufacturing market. So when it comes to backstopping liabilities arising out of warranties sold with the equipment, historically we take solar modules, and now if we look at battery cells, this is being all manufactured in Asia, right? This was by far the biggest market when it comes to insuring or backstopping warranties or insuring performance guarantees of renewable energy equipment.
So we can't say. Sorry, Jan, for interrupting. So we can't say that Europe is a more experienced and mature market relative to other areas in the world.
No, when it comes to traditional insurance policies, I think for sure. When it comes to wind, and again, we, as you know, that we have we predominantly focus on solar, battery storage, fuel cells, and different forms of bioconversion and energy efficiency. So we had not been very strong in wind, and this is probably one of the reasons why I said that we had been under represented in Europe. Europe was historically a very strong wind market, both onshore and offshore, right? So I think when it comes to wind, it's by far the most mature market. But this is also one of the reasons why a lot of the performance and machinery breakdown aspects related to wind projects are covered by so-called traditional, quite comprehensive and wide in scope machinery breakdown BI policies. And this is where I think the brokers and the insurers in Europe had been very strong with, especially the London market. So by no means I want to underplay that. I think it has been very strong in terms of wind. But then I'm talking from my perspective. So the technology, the four areas that I have mentioned, which is historically the manufacturing of the equipment, the large projects, or the large scale projects where large reinsurers, insurers have appetite for. You need to have some scale in order to place those insurance policies. This has been, the US was the dominant market. And currently, if you ask me geographically, what is the what are the markets where we have most demand for in terms of placing project performance policies for different type of solar battery storage, fuel cell, and bioconversion project performance policies. Number one is US. Then it's followed by Europe. But I would say that 50% of the requests that we're having are from the US, maybe 60%, and then it's probably about 20% is from Europe, and then it's the rest of the world. But this should be not used as a reference for how mature the market is in terms of having projects on the ground, because remember that a big role which the entities which play a very big role in how much of those insurance policies are being replaced are also insurance brokers. Insurance brokers are the entities which, especially in the industrial end, they represent. They're hired by project developers, asset managers, technology companies to place a variety of insurance policies, property, liability, etc., for them and for their projects. And it really often comes down to the insurance brokers to also understand and the type of niche and more specialized products that we offer, and be able to explain those and suggest those to their customers. And what I can say from my experience is that the European market, at least we felt that like the US broker market was much stronger, and historically it was always, from a broker point of view, the strongest market globally, and Europe has followed. That being said, there is still more work for us to do in Europe. So we create more awareness, for the availability of those products, both directly across the industry, but also across the broker industry. Yeah.
Got it. And how does Asia fit into this whole overall picture?
I would say that so again, we have to go back. What is the buying motivation for those performance insurance policies? There can be three buying motivations. I mean, one is obviously risk transfer. This should be always the predominant buying motivation for every insurance policy. You want to transfer some risk off your balance sheet to the insurance balance sheet, and then you just evaluate what's the cost benefit of it. But then the buying motivation could be also, as you mentioned, the word bankability. Buying motivation would be, well, maybe I, as a project owner, developer, technology provider, I don't think I need any performance insurance, but my stakeholders, my investors, my lender, they would like me to buy some risk transfer, at least to protect their investment. So this is very often the buying motivation. So we may be getting requests directly from project owners, but we may be getting requests also from asset managers, from lenders directly, evaluating options on how to make a project fundable from their perspective, and what are the options to transfer technology risk, which they're not accustomed of doing. So we work a lot with brokers who represent also financial institutions, and only with brokers who represent industrial companies, right? And the third buying motivation could be a bit of credit enhancement, and this goes back more to the warranty piece, right? So if a company, if a manufacturer of equipment issues a warranty for 10, 15, 20 years, and they don't have that balance sheet to make that warranty credible towards their customers and their stakeholders, then they may be buying an insurance policy which backs that warranty. So it's a performance insurance policy because it's backing a performance warranty, but you have that additional benefit of having an investment grade balance sheet sitting behind that insurance policy, unlike the warranty itself.
Got.
So to your question about Asia, so sorry, because
no worries.
What I do,
Putting everything into context.
Putting
everything into
Asia,
context.
To put exactly. So Asia, I think globally the predominant driver is I would say enhancement of investment, whether this is equity form of investment or getting debt into the project, more debt, cheaper debt, longer debt, because we can provide a longer term policy. This is the predominant driver of these policies. And then it's only risk transfer. And especially in Asia, the interest in understanding what is actually what are the downside scenarios, what could happen to the project, and what is the risk that we think as a technology provider, as a project owner, that we want to transfer out is I would say less present than in the Western markets. It's predominantly driven really by demands from investors and financial institutions who just would like to, but also the project owners who would like to get better terms, for their investments. And if there is a cost benefit, then it's a win-win-win.
Right. Still talking about the Asian markets in general, we've got two kind of scenarios. One is and I guess most of Asian markets are like that, the non-merchant markets, where you have a long-term power purchasing agreement with typically state-owned entity in places like Vietnam or in Indonesia, and then you've got situations where it's all merchant, right? That you don't have a PPA. At best, you may have a corporate PPA, but sometimes you don't even have that. Does that make any difference in terms? Because earlier you mentioned about the offtake risk. So obviously, if the person can't pay you, that's pretty obvious risk, and you was also saying that that's not necessarily what you look at. But what about merchant markets versus non-merchant markets? Is there do you have some thoughts on that?
We are agnostic to it as long as we cover performance and output. Shortfall in the project, right? So as long as what we say in the insurance jargon, as long as the insured perils, so the risks that we cover are related to the technology, maintenance, equipment, design of the project, resource risk, then we remunerate or compensate the insured for a shortfall in production through what is a fixed compensation rate in our policy, right? So let's say it's a 15-year policy. The insured has the ability to index the compensation rate for each of the 15 years, but it's important that this is agreed when the policy is being signed. And we don't compensate, or we don't monetize the shortfall of production through a live market price, right? So we don't take market price risk. It's insurance industry is also a highly regulated market, and there would be specialized insurers who would have the ability, or reinsurers, to take pure market price risk, but then also nobody would take market price risk for what usually the debt providers are after 5, 7, 10 years. That's I don't think that's available in the market. So to your question, we are quite agnostic. I think if remember, our policies are long-term policies, matching usually the duration of debt or of a warranty. So it could be, for a project, could be 5, 10, 15 years. If the market would expect the insurers to include some market price risk, then this would have to be a significantly shorter term policy. I don't know how short term, let's say annual, like most insurance policies. But then you lose the benefit of a long-term non-cancelable policy, which is matching the duration of the tenor of debt. So it's a give and go. With the existing product, you have let's say a 15-year non-cancelable policy, and if in year 5 there is a substantial technical failure in the project, which is causing shortfall in production, the supplier of equipment is bankrupt, so they are not replacing the equipment under the warranty. The project decides not to replace the equipment, then the insurer will be paying a related loss in revenue for each of the years 6 to 15. That's our catastrophic scenario, so to say, right? And the equity will be always bleeding a bit as well, but the insurer will have a substantial loss throughout years 6 to 15. That's the benefit of a non-cancelable long-term policy, to the benefit of the lender. So you have debt service protected. Now, if you include market price risk, maybe the insurers would, if they would have appetite, then probably for 1, 2, maybe years, and you lose the benefit of having that long-term non-cancelable policy. So maybe you get a big loss paid out in 1 or 2 years, but then nobody will renew the policy under the same terms.
Right. So Jan, we've gone through kind of the basics, let's call it 101, of the markets and how insurance actually works. Can we talk a little bit more now about what are some of the kind of key developments in these markets, especially in Asia? Are there any specific key developments, any key issues that you want to highlight, and perhaps obviously without mentioning any project names, etc., but maybe 2 or 3 case studies to give a little bit of color to these issues and key developments?
I would say, there is for us there is a generally mature equipment manufacturing market, which is China, and then the other places where across Asia where they have their manufacturing facilities. But this is predominantly solar cells, panels, but also lithium-ion cells. So this, what I say, it's a mature market. It's a mature market in the sense that those non-traditional performance policies are embedded into the annual buying behavior of those companies. It's an insurance policy that they are buying as they are buying a property damage policy for their factory and a liability policy for their product. Right. So I think this is an interesting example of how you move from a product which was very bespoke in 2008 when we were starting and was still bought by a handful of companies to now. I think it's about. So I would make a guess about 60% or more of the industry that is actually insured, which is quite high in China. I'm talking about the solar industry, and I think the battery storage industry will follow, because it has different, but generally speaking similar dynamics in terms of Chinese battery cell suppliers supplying big volumes of cells to the integrators globally, and then the integrators building their systems with their own warranties, but relying on the warranties from the cell suppliers. When it comes to project business, so this is equipment warranty, as I mentioned, right? So then when you look at other Asian markets, Japan is not really a manufacturing market anymore. Not necessarily Korea is not really a big one, other than for maybe certain types of fuel cells and obviously battery cells as well. But the likes of Samsung or Hyundai will not be buying performance insurance because they have bigger balance sheets than insurers. So if they want to buy it, they probably would expect a price which the insurers would not be able to support. Although they had their struggles as well, right? So there were severe product recalls that they had in the past, which they sustained themselves. So when it comes to manufacturers market is still predominantly China, followed by Vietnam, and then obviously India, which India has been a very, I'm not afraid of using that word, difficult market for us for years, because it's been always coming, but still the volumes, the quality was not there really for it to be an attractive market to provide this corporate insurance products, backstopping the warranties. And this has, I would say, significantly changed over the last 2 years, significantly. So, we've all seen the, press releases about big investments that the likes of Reliance or Adani are making into renewables. So that the volumes, the types of lines that they're building, this is all, much more mature than it was 2 years before that. So this is a market in which we are, now actively getting involved. Again, starts with solar, and this is what their predominant focus at the moment is. But it's also a market where projects and financial institutions are showing demand for those products. I think it will take some time until probably the hit ratio of those policies will be quite limited. But for example, as a comparison, mainland China is not a market where performance insurance is being considered even for local projects, right? I mean, as long as you don't have proper non-recourse finance, these policies will not have a place, because they directly tie into protecting debt service on a non-recourse project finance scheme. Right? But therefore, Korea and Australia have been quite active markets in the past. So Korea has become a quite active fuel cell and bioconversion market. We've placed few policies and waste to energy space in Korea. When it comes to Australia, it's predominantly battery storage and signals of also demand for performance insurance for bioconversion processes. So you see, so these are those areas which are less commoditized, and bioconversion is by far commoditized. These days, basically almost every project is using a slightly different technology with very limited track record. This will change over time as those technologies get more mature and commoditized, and the problem will be the amount of the projects and the aggregation risk, so to say. But for now, it's really getting those first projects over those first bankability hurdles, and this is applicable to both storage and bioconversion. I think with storage, the concern is around the performance warranties, because they're getting longer and longer with very limited data, historical cycling data to really predict on how the degradation will happen over 15 years or 10 years. It's more based on predictions, and then again, the credibility of those warranties is relatively low. So I think there's a natural demand to try to backstop those warranties. So battery storage and bioconversion are, I think, for us the two areas where we will see most demand in Asia, but predominantly in I would say in more developed markets.
When it comes to, I guess the difference between, and as you know, I do finance, so I'm pretty stupid when it comes to technology, but I would guess that the waste to energy bioconversion technologies are relatively more mature, and the kind of the evolution or development of this technology, you're not seeing any kind of major. It's more an evolutionary kind of process where it probably get better, a little bit more efficient, etc. Whereas with battery storage, you may see in the short term, like 2, 3, 5 years max, some very drastic changes in terms of the materials used, where it's manufactured, etc. Would that assumption, financial analyst assumption, be correct, Jan?
I think on the waste to energy, the biggest, you're right that some of the processes are well known, but they're well known for a certain type of feedstock. And now, when it comes to managing waste, it's all about changing and utilizing more and more waste and different types of waste. So a process that has been using a conventional municipal waste feedstock, now they'll try to apply this by using different types of feedstocks, and then it's all about which adjustments to the process have to be made into the equipment, and how will the mass heat balance of the system change. So it's really about those predictions, and whether any using that feedstock could expose the system and the facility to any unexpected, like, catastrophic events. The whole thing blows. I would answer in that way. When it comes to storage, generally speaking, yes. I mean, I think there is a similarity to solar in terms of, solar, crystalline modules, not getting into different types of cells that have been used over time and change, but most of the recalls or serial defects that have been seen in the industry over the last 10 years was due to material issues. Yeah. Well, there is more materials going into solar module than there is into a solar cell. But this is what we are actively kind of underwriting and learning and investigating, is what are really the main drivers for potential degradation in storage. And obviously we have our findings, but I don't want to speak openly about those.
Sure.
I think the biggest challenge, as you said, is the upgrade in the cells happening on a 6-month basis, where even if you get some historical cycling data, degradation data about a certain product type, and you try to make predictions and you build models how to predict the degradation for that particular type, well, 6 months later it's already not applicable, because there have been changes A, B, C, and D made to the cell, and now you get, from a technical point of view, you're trying to understand how this could impact predictions, but also you would like to have some testing to see if there is any indications of any additional volatility in the degradation. And you have to wait again, and then once you wait for the test results, the cells have been upgraded again. So I believe that the insurers are doing a proper job in actually transferring a lot of risk out of the industry, given how fast the industry is currently developing.
So I guess there's a few variable elements, and I wanted to dig in a little bit into energy storage, because I think that, as far as I'm concerned, it's really the most important area of development in Asia, for Asia to go from brown to green. Obviously, because when there's no sun, you don't have solar power, and there's no wind, you've got no wind power. So that's the importance of storage. But I guess there's some moving parts, and the first moving part is how the operator or manufacturer, both, of the energy storage are actually managing it. Because, and I'm referring to, traditionally, people like myself who use cell phones know that, it's not good to charge your phone, 100% of the time. Better have it, I don't know, up to like, and then bring it down to maybe like 20, 30%, and then recharge it up to 90, 95%, and that you can have more cycles and prolong the life of the battery. And that's as far as my technological expertise goes. But I know it's a lot more complicated when you've got, huge batteries, and the batteries have got slightly different materials. So obviously the testing is quite is quite complex. So you've got a materials variable and you've got a utilization variable. And that's going to change quite rapidly over the next few years, I believe, because of innovation when it comes to battery. I mean, everybody that we can think of is working on new battery technologies using, more available materials, less rare earths, et cetera, et cetera. So how do you kind of, honestly speaking, just cope with that? I mean, it sounds like it sounds a little bit different from solar, because I see solar over the last 10, 15 years more as an evolution, the gradual improvement, you make a few tweaks, et cetera, and you get that. I still remember when people were happy getting, 10, 11% on a ground solar utility scale project. And now you're talking about, 20% and sometimes even a little bit more. So that's really what we're talking about. So how do you deal with the energy storage side? And I've got no idea if my question makes sense. So please rephrase it in whichever way you want.
I know it makes sense. So when I was comparing to solar, and it's a very far-going comparison, and it should not be made. In the back of my head, I had the round-trip efficiency and capacity degradation curves for solar cells and systems, and making this widespread comparison to a watt peak PP max degradation curve for a solar module. But as you say, there's the devil sits in the operation and utilization of the equipment, right? Solar module is out there in the field, and as long as you have sun, it just generates electricity. With the battery, you can decide how you want to use it. So the user case is very important, and the warranties that battery system integrators are offering to their customers will be different from project to project, depending on what the expected user case of their customer, the project owner or the asset manager, will be. Now, a proper battery performance warranty is actually it should be a quite sophisticated document. It should predict on how you change what you guarantee depending on the operational conditions of the system. And the operational conditions of the system would be, the charge under which you discharge, the amount of cycles per day that you use, temperature, etc., etc. And then actually, when you look at those really advanced warranties, they have a breakdown and lots of permutations of, if you stay within the amount of cycles per day, but you change the charge under which you charge and discharge, then it's, the warranty drops this level. And then if you do more cycles per day than agreed, then it drops, from the amount of cycles guaranteed will drop from X to Y, etc. So your point is very valid, because the user case makes a big difference. Now, that's why it's complex enough with the limited availability of the historical technical information I was referring to before, to underwrite a utility scale. A utility scale battery project, which has a fixed user case. So it's just using for a particular purpose, and you have, 1-2 cycles a day at discharge. And that's the user case, which is repeatedly being used, and you don't expect that user case will change. Now, if and more batteries being used, in merchants market to optimize the grid, there's a huge play with optimization companies are playing now, because they decide how to maximize the profitability of the battery system in terms of the revenues that the project can generate by utilizing the batteries. And they may decide from day to day to change their sales strategies. And what we have seen is that actually very often those warranty conditions are breached in the very early stage, because the project owner wants to maximize the profitability of the system. And what really is secondary is, to worry about whether the warranty will last now instead of for 8 years, only for 3 years, when they know that in the next year they want to make most use out of the current conditions, the grid, and just maximize the usage of the system. This is the reason why we have been working for a while on understanding to what extent we think we could provide like a savings guarantee on a storage system, right? Because when you have a solar system, we can provide a revenue guarantee on a solar system again. Or a production or a kilowatt hour guarantee. But again, for storage, that's way more complex because this optimization plays a big role, and it's moral hazard. If you insure a certain sales strategy, and then how do you make sure that the sales strategy doesn't change next day, and that the equipment will not be utilized in a different way? So for now, we're trying to limit ourselves to those round trip efficiency and capacity, also availability warranties, and maybe liquidated damages related to reduced availability. But offering a kind of revenue/savings guarantee, that's very complex, because then you also have the merchant's price component about which you were talking, right?
And you were talking, we talked about the technology side of energy storage. My, again, limited technical understanding is that the digital side of this is also very, very important, insofar as that's really how you manage and operate the battery, right, through the digital systems. So when you look at the technology, materials, etc., of the battery, do you also have to do a in-depth look at the digital solutions that the operator, the manufacturer, is using to maximize the operations of the battery?
So, if we refer only to the equipment and the battery management system, BMS, yes, that's part that's obviously insured as well. And then obviously the ability to maintain the systems and understand what failures exist in the system is coming down to the use of the BMS. So this is covered as well, and that's the system that we use to validate claims. But on the optimization side, that's way more complex. This is not where we are, because there's a lot of human decisions there.
Yes, indeed.
Right? And then those human decisions are being made based on what's the best for the. There's a trade-off between the optimizing the reliability and durability of the system versus optimizing profitability in a particular day, month, or year. And this is why at this moment, it would be a struggle for an insurer from a moral hazard point of view to provide like a savings guarantee. Obviously. So what we are working on is trying to identifying to what perils, to what events we would limit such a coverage, so that it's a good win-win for both the insured and the insurer.
Got it. So maybe we can look a little bit forward. You partly answered the question I'm going to ask, which is, what's your outlook? Where are the opportunities, at least in the Asia region? And you did kind of say that, well, basically when you're talking about developed Asia, the biggest areas of growth are battery storage and bioconversion, WTE. Do you have any other kind of thoughts about the outlook in Asia over the next few years when it comes to your business?
But the outlook is typically based on reactively on what the demand is, or the inquiries are that we are seeing from the market. And while in Europe and in the US, we are seeing now more and more inquiries related to, and this is very early stage in terms of project advancement, and some of the technologies are also very early stage, but two magic words, obviously, carbon capture and hydrogen. We have not seen any of those inquiries popping up yet in Asia. Right? Energy efficiency projects, yes, but that's nothing new. Like for example, with inquiries, can you guarantee savings related to, I don't know, the replacement of streetlights from conventional to LEDs, like the city of Bangkok or city of Dubai, etc. So this is more plain vanilla, but those are not very frequent requests. The highest frequency in Asia right now is storage and bioconversion. In terms of new requests, I think what surprised me a little bit is that because it comes down really to the incentives that the governments are providing, like Korea provides particular incentives when it comes to using fuel cells. So there is it is a strong fuel cell project market. I think going forward, I mean, you don't really expect other countries to provide this type of incentives. So I'm not sure how. I don't know, maybe then at some point one could expect this in Australia. But nothing really yet in the space of hydrogen or carbon capture.
And I guess one last point is just to wrap it up. I mean, do you have any kind of final thoughts, messages, and ideas that you want to share?
I would love to, if our if the inquiries that we are receiving, it's really like a dream to an insurer that if somebody comes to you asking you to backstop or guarantee a certain floor on production or output for a certain whatever the technology is a project, the dream to the insurer is that the inquiry includes, a proper assessment done by the project themselves in terms of what they think really is that the risk is that they would like to transfer. Where we really struggle is when the inquiries are like, this is project A, and that's it. We just know the size of the project and the technology, and then a very pro forma early cash flow model. And then the question is, what can you insure? And because it's very, I mean, we can insure everything. It's just a question of, not everything, but we can insure a lot of things. It's just a question of price. But the first question back is like, for us, what is your buying motivation? I mean, are you trying to smoothen your cash flows? Are you trying to ensure a very remote, unexpected downside scenario just to protect, a certain very low subordinated level of revenues to the benefit maybe of a financial institution? Because depending on what's the level of coverage is that we're expected or being asked to provide, our assessment will be also very different, right? I mean, if somebody is asking us only to insure 60% of the expected output versus, for example, 95% of expected output, obviously the depth of our assessment has to be very, very different. Not only speaking about the cost of the insurance policy. So this is very, I think, helpful to the insurer to provide optimal terms to the project when we understand what kind of task are we being asked to fulfill. Do they want to use insurance to smoothen their cash flows? Then we know, okay, it's going to be what we call an attritional loss type of cover with probably a bit of cash swapping. But we really need to dig deep into the technology understands the volatility around the expected output in order to provide such a coverage, or is it really like, look, I only need to insure a highly unexpected scenario and event to fulfill a requirement set by my investor. What is the minimum information that you need for that, and can you give me a rough cost of range? So this is always very helpful.
Got it.
Yeah.
Well, listen, Jan, I've abused too much of your time already, and I'm very, very, very grateful that we could finally get to chat about the whole insurance game when it comes to the energy transition and decarbonization in Asia, which I think is a very, very important and often not discussed enough topic. Just want to thank you for participating in this episode of the Asia Climate Finance Podcast, Jan.
Thanks a lot, Joseph. And I can only expect we'll be getting a lot of inquiries from Lisbon these days.
I'm sure you will. Thank you again, Jan. Thank you.
Okay, appreciate it. Thank you. Cheers.
I hope you did enjoy this episode of the Asia Climate Finance Podcast. I would really appreciate any feedback, topic ideas, etc. My contact is in the show notes. Thank you.